All right. Welcome to the weekly roundup, September 30th, 2022. Ben Hart, Scott Goodfellow,
Hello, hello.
also known as Shooter McGavin on my name tag here today. Uh, okay. So let's just kick it off. Let's kick it off because you know what? It's the end of a week, a month, and a quarter.
Yes. Yep.
So I'm just going to read my headline here. You can react to it. I
Okay.
feel like this says it all.
Okay.
Dow
Okay.
tumbles 400 points heading into close as stocks wrap up an awful week, month, quarter.
Wow.
Ben Hart, do
That
you
sounds
agree?
that sounds amazing.
I know.
Amazing.
It feels like
Yeah.
those are often the headlines that I read on these Fridays these days.
Well, 2022 has been much more like Q1 of 2020. So yeah, we've had a year of everything, but inflation seems to be the thing, and central banks grabbing most of the headlines here. So lots to cover. I think I teased in my daily today that Hedgeye came out with their quarterly yesterday. So I want to cover a bunch of those things today, but most of it is just around where we are and where we are at this point of the cycle. And I've been saying for probably a month and a half or so that I think we're in a recession, early stages of it. So we'll kind of go through that. And yeah, the markets. There hasn't been a lot of places to hide with the exception of the US dollar. So we'll cover some of what's happening with the US dollar and what's happening against most of the major currencies in the world as well. So, lots of stories to go through, but inflation and the dollar are probably the biggest ones.
Nice. Well, do you want to start there? Like, what do you
Yeah,
want to
I,
start
I
with?
think so.
We may as
Yeah.
well switch up the format a little bit today, and let's just because I know you have a lot of material to cover, so
Yeah.
let's just go ahead and start with that.
All right. Let me know when you can see it. Hang on. Let's get it going. Share. All right. Are we on? Can
Yep,
you see it?
we're on.
We're not in the middle of it.
No.
Our faces?
No,
No? We're
no,
good.
we're good.
Okay, good. Yeah, so I think so. I mentioned this at the outset here was the is really what the U.S. dollar has been doing, and as we think about this, it's the one thing that's gone up this year, and so had lots of questions around why is this happening, what's going on, and as you probably know, most of global trade's done in U.S. dollars. So as liquidity comes out of the system, as everyone's kind of pulling back cash and U.S. dollar cash, that ends up putting pressure on all the major currencies around the world. So obviously we look at Canada here, and I think these statistics are from a couple of days ago, but Canadian dollar is one of the stronger ones, down 10%. Really, if we look after today, it's closer to 10%. And that's because we're energy tilted, and that's kind of held us up here. But it's the US dollar that's really put pressure on everything else. If you look at correlations to the US dollar, the stock market, bonds, Bitcoin, currencies, everything is trading what counter to what the US dollar is doing each day. So today, where markets are down, bonds are down, you get a US dollar strength today, where the US was up about 1.5% versus Canada today. So before I get into kind of the hedge, I just want to touch on a couple things. And so we've talked about demographics a fair bit, and I thought this was interesting and worth just having to think about. I've mentioned Canada has the best demographics of the G7. This is an interesting look to see versus kind of the major globals of the world, where US has one of the better kind of demographic population growth. If we stretch the forecast out to US and China are two of the majors, where the rest of these countries end up looking like their working population is going to continue to slow dramatically. So that'll be interesting to see how that has an impact on things. And the other piece is really petroleum and there's lots of thought around what's happening in the world, and who really controls the price of oil and energy right now. So I thought this was an interesting chart that I came across this week. Just shows that the United States has been growing dramatically, and so as we think about how the world kind of evolves from here, there's lots of thought that a lot of people are thinking that the U.S. economy is out of it, and that the rest of the world's going to go quickly. And so these are a couple of things that I would say, not necessarily to count them out just yet. They have massive energy production. They're reshoring technology. They have good demographics. I think these are important things that we think about as we invest for the next decade.
Yeah.
Yeah. Couple more things just longer term on the dollar before I jump into the inflation information. And this is just a historical look back from the kind of the early 60s to what's happened when we've had these major appreciations in the dollar, and what's happened to the economy, where these red bars would be obviously pretty material recessions that they face. But this is a period of rising dollar, which we saw, and the moves of those magnitudes. And this is what we've seen so far. So I think this is important to think about. But if you look at this breakdown, 96% of all trade invoices in the US is in US dollars, 74% in Asia Pacific, 23 in Europe, and 79% rest of the world. So this is a big part of why the US dollar has been going up, as this liquidity continues to get sucked out of the system. And so this will be important to see, how asset classes do with this kind of headwind that currently facing.
Gotcha.
Sorry, I skipped through a couple there. All right. So then getting kind of meat and potatoes about GDP. And so I've been saying that I think we're in a recession. This is the US data. The Canadian data looks quite similar as well. They just hadn't put it out yet, so I couldn't drop it into the presentation here. But we're looking at two separate pieces here with year-over-year projections and then quarter-over-quarter. Some people like to look at the quarter-over-quarter because that is when you truly define that you're in a recession. And so year-over-year, as we head into the last part of the year here, Q3 and then Q4. If you look at consensus, which is Bloomberg consensus for Q4, you're looking at roughly flat 0.6% GDP growth. If you look at Hedgeye's forecast, they're actually calling for a little bit of an acceleration more than that, but we continue to decline from kind of 129, which we are now, to 0.5% to 0.2 to negative in Q2 of next year. So that's the year-over-year numbers. Where, you get in the typical recession data, they'd be forecasting Q1, Q2 are both pretty big negative prints. So that's your kind of recession Q1, Q2 next year. Why this is relevant is, I believe I put up the slide last week where I was showing kind of the recession and markets on top of each other. And so as markets bottom, recession starts, and you tend to see the actual recessionary data lag after what's happened to the markets. So, it's important to think about if they're forecasting recessionary data in Q1, Q2 next year. At some point, that market backs it up and says we're happy to bottom and start to anticipate what happens when you get into negative prints, and that's where you get central bank intervention, where they go in the other direction, cut interest rates, or go on pause and then cut. But these are important pieces to think about.
Gotcha.
Okay, a few more. I'll try to keep rolling through here pretty quickly, but this is CPI. So Hedgeye estimates, and then Bloomberg. Bloomberg's is the yellow, where Hedgeye's data would be the blue. And so, I think one of the things that this kind of continue back and forth is, when are they going to do things? And so as I look at it, I think that this inflation impulse that we're having is really changing the game relative to what's happened in the last 20 years, where they'd probably start to pivot aggressively now, but as a result of the fact that this inflation number is going to continue to run a little bit higher than we've seen in the last 20 years in my working career, I think we've got to keep this in the back of our mind. If we do come out at still in the mid fours in Q2 of next year, that's going to put a lot of pressure on the central banks to continue to push down that inflation narrative. So, just think about the timing of everything, but they said inflation's number one priority. So certainly interesting to pay attention to, but rate of change is without a doubt slowing right now. And that pace of that's going to really depend on what the central banks do from here.
Gotcha.
So busy slide again, but I'll just point to the two, which would be Canada and the US. Any questions about the other ones, we can certainly look at that. But these, if you recall, the red ones are the quad fours. Like this is growth and inflation slowing together. And so you have 4 quarters of it here, both in Canada and the US. And so as I've called out before, China, I do think that we're in a kind of a different setup than we have in North America. So these ones and twos, these are, you know, a one is, you know, you get perfect financial conditions. Basically, you want to own consumer discretionary, you want to own financials, things like that. So you got a couple of places in the world that are showing promise. Certainly wouldn't be buying Russia here, but if you're just looking at a pure data perspective, these are the important things to think about. So this is growth and inflation, and then how strong are the signal strengths. One of the biggest callouts would be the signal strengths are both extremely strong for both Canada and the US. You're looking at kind of 98% likelihood that these things happen.
Gotcha.
Okay. Zip through a couple of more here where just 2 or 3 more, and then we'll be done. So we've talked about this kind of on and off over the years. Some of the podcasts we've done, we talked about, you know, flows and fundamentals and where's the money, and, you know, how do you participate in what's happening. And so I thought this was a really interesting slide to just think about where the assets have gone. So ETFs right now account for, well, at least at the end of last year, something in the neighborhood of $7.1 trillion, where hedge funds are still, you know, $2 trillion, but they've been slowing. And if you look at this note at the bottom here, it says JP Morgan says systematic trading accounts for 90% of US equity trading volume. So when we think about investing, these are important things that could really impact the future prices. And so fundamentals, yes, important, but flows make a big difference. And so we continue to track this and take it into account when making decisions.
Yep.
Last two here, so wealth effect, and so, you know, these are clear numbers which we've, I think, seen historically. But why I thought this chart was interesting is, yeah, this gives you an idea of how much it accounted for from a GDP perspective. And so if you look at this, combined equity and housing wealth contributed, you know, 2.45% to Q2 22 GDP numbers. So as you see the wealth effect falling, which is interest rates rising, prices of equities and housing and things like that falling, that ends up putting significant pressure on GDP. If you look at the forecasted, you know, you're looking at Q4, that's less than 1% of GDP with the wealth effect going negative here. So these are all things that take into account where and what point we're at in the cycle, and, you know, when and how we should make decisions from here.
Gotcha.
Yeah. And so just the last one before we kind of jump on to any questions, and maybe I'll comment a bit on like what to do in portfolios here. But this is, you know, one of the things that CPI is, it's a rate of change number. And so as clients have asked me, do I think, you know, inflation continues to accelerate? One of the major inputs is energy. And so March of last year, we had oil averaging somewhere around $120 a barrel. And so that was up roughly 100% from the previous year. And so you got a massive impulse of inflation there where, you know, at this point, we're starting to see that slow. So if we get into March of next year and oil is still around plus or minus here, it's actually going to be a drag on the deflationary numbers. So if you look at here, you know, you get these kind of these two kind of variables where this first 2 quarters of next year, it's going to be a lot harder for that inflation number to continue to grow quite quickly. And, you know, if you look at that from a perspective of what does this mean to markets, it's important that I think we take this into account when we're making our decisions.
Gotcha.
Mm-hmm.
Okay, great. That wasn't that many.
Yeah.
I mean, it's more than the allowable 3, but
yes,
it's the quarterly, so we'll allow it.
Yeah.
So that was from our macro research company, Hedgeye, or one of the ones that we follow, Hedgeye. So
yeah.
So you watched the whole quarterly reviews that you did?
Yes.
What's the kind of, if you were to sum it up, how would you sum it up? Or you just did?
No. I think I summed up the data.
Yeah.
What was, I guess, the feeling of it? I think
Hmm.
is what I think you're asking me.
Yeah.
And the feeling of it is, particularly from their perspective, is they are momentum based investors, and a lot of the data sets that they take from an investment perspective is the momentum. So when I look at their longs versus their shorts, for example, so they provide research on thousands of stocks, and on their long investment ideas they have one, and they have about 25 short ideas. And
Mm,
if you look at their ETF portfolio, at least for a short term basis, like first quarter,
mm,
or for the next quarter, again, they have two longs basically and a pile of shorts. And
hmm,
their longs would be an interest rate and some kind of US dollar proxy, we'll say. And if you look at kind of what their medium term outlook is, 3 months to a year kind of thing, their long positions will be gold and US dollars. So
mm,
um, so when I think about the sentiment, it is kind of looking forward for the next quarter, at least based on their research, that we're probably going to we'll probably put in some kind of bottom in the next quarter,
mm,
and how that's going to look and the timing of all of that, I think it'll be important to watch. But the data continues to slow, the economy's slowing, prices are getting closer towards their bottoms every day, and so I think they're in a patient, let's have some cash and get ready to take advantage of those opportunities.
hmm.
Yeah.
Okay. Great. Yeah, I think that's pretty consistent with what we've been hearing, right? So, and what we've been telling people, really, it's pretty
Yeah.
consistent.
Yeah.
Just as we move on here, if anybody has a question, obviously, just click on the Q&A button on the bottom, type it in there, and we'll get to it. What do you want to do next? Do you want to talk about portfolios, what we've been doing, and
Hmm.
what we're looking at for next week?
Yeah. So let's touch on portfolios there first. There wasn't a lot of changes this week. Really more watching and looking at the opportunities that are here. And as I mentioned, I think in some of the dailies too, we're seeing 52-week lows on so many companies right now. And I think almost every day I pull up Thompson, look at each morning and fall throughout the day, getting all these companies putting in new lows. So spending a lot of time looking at those, and saying, where are we, and how can we best maximize kind of the future return. So being careful now, but starting to get ready to be more aggressive when that opportunity presents. And so that's where spending a lot of time, where these companies, like, I think, I don't know if I mentioned Bank of Nova Scotia or not last week, but new 52-week low here, dividends almost 6.25%, trade at 7 times earnings. Like, these are things that we'd start to pay attention to, and watch closely and say, where do we go from here? What's our future expectation for the next couple of years? And how do we make sure we're best positioned?
Right. Makes
Yeah.
sense.
Mhm.
Okay. Anything else you want to talk about?
Uh, I think really the last piece is that you made a point there on the Dow, and you mentioned at the
Mm-hmm.
start, is that both the S&P and Nasdaq touched 52-week lows today. So
Mm-hmm.
Nasdaq's down about 35% off its highs, and so
Mm-hmm.
these are kind of short-term numbers, obviously important to look at. But if we stretch that back and we look at kind of the longer-term trend lines, where you'd have kind of that average return through the median, where and you follow kind of how far we are off of that long-term trend. And Nasdaq's currently 2 standard deviations below its long-term trend line. And so historically, these have been points where we'd say, let's think about what and how this is going to play out. And if you have the view that you think rates come back down, this is certainly an opportune time. If you have the view that rates continue to stay high and continue to go higher, then you have to wait. But these are things that are important to think about for what's coming in front of us, not what happened behind us.
Sure.
Yeah.
Okay, last call for any questions. Just give it a minute there. End of the month too. Do you have anything coming up as far as any client should know? Any housekeeping issues that you can think of? I guess just like if you're looking to book meetings or anything, you can do that in our signatures.
Yeah, so I guess from a housekeeping perspective, which we try to do throughout the year, particularly this year, is if you've had, in a lot of cases we've had gains in the last couple of years. So in a lot of cases I've been realizing some of those losses sooner than later instead of pushing them off into December, which we sometimes do depending on what's happened in the year. But because we've had kind of a choppy start to the year here, I've been doing that sooner. If there's extenuating circumstances that I'm not aware of. So, recently I had a client who had sold a commercial building and they had a big capital gain personally. And so we were able to kind of realize some losses, help them offset those gains and really reposition the portfolio for what's happening today. So if something like that happens, I'm not aware of, then certainly let us know and we can trigger some of those changes.
Awesome.
Yeah.
Okay, doesn't look like there's any more questions, so we will get on with our weekend here.
Sounds good.
Yeah, hope everybody has a great weekend, and we'll see you next week.
Sounds good. Take care.
Yeah, have a good one.